We have a particularly full agenda today. We have had a workshop yesterday for information gathering and some questioning. So I hope that we can move through our agendas, both public and public excluded, with some ease. I welcome in folk from Bancorp, and we also have PwC at some point coming into the room. Could I ask our visitor today to this meeting, our Deputy Chair, Peter Scott, to open with a Karakia, please?
Kia ora, Karakia, Timatanga, whakataka ho, whakataka ho ki te uru, whakataka ho ki te tonga, ki a makina kine, ki uta, ki mataratara, ki tai, hi e akiana, ti atakura, hi tio, hi huka, hi hauhu, ti hei mauri.
We have an apology from the Chair. Are there any further apologies? Not. That apology will be noted. Do we have any conflicts of interest on matters arising today? There are none. Public forums and deputations or petitions, there are none today. Extraordinary and urgent business, are there any items that members wish to bring to the table later? There are none. Notices of motion, I am not aware of any notices of motion. That brings us then to item number 7, the 7.1, the unconfirmed minutes of the Audit, Finance and Risk Committee meeting 23rd June. Are there any matters of accuracy that members wish to comment on or change? There are none. Could I have someone then please move and second that we accept the minutes of that meeting? Graham McGlynn, Councillor Marshall second. Is there any conversation? None. Then all those in favour, please say aye. Against, carried. And for those online, your silence is taken as, and yes, please speak up or put your hand up if you wish to negate any motion. We move then to item 8, report items. 8.1, Audit, Finance and Risk Committee Resolution Status Report, August 2022. Giles.
Thank you, Chair. This is the standing agenda item with the resolutions made by the committee with an update on progress. Happy to take any questions or comments.
No questions or comments. Then could I have someone please move and second the recommendation or resolution that sits on the screen. We note the status of the previous resolutions provided and the status of Audit, Finance and Risk Committee Resolutions Report, August 22. Councillor Mackay, Councillor Southworth, any conversation? None. All those in favour, please say aye.
Aye.
Against? Carried. We now move to item 8.2, outstanding management actions from internal. Page 22. Audits, external reviews and the like. John Gamba, are you speaking to this? You can speak to it.
So again, it's the standing agenda item on the actions from previous audits. What we're proposing to do is that these items going forward will be incorporated into the internal audit update report. But for completeness, this shows the status and those items we're believing are closed. But happy to take any comments or questions on those.
Okay. There are no comments or questions. Could I then have someone please move that we received the update on outstanding actions from the previous internal audits, external reviews and previous meetings, and note that all items on this report are now closed and this report is being superseded by the committee resolutions and internal audit report. Moved by Graham McGlynn, seconded Councillor Edge. Any conversation? If not, all those in favour, please say aye.
Aye.
Against? Carried. We now move then to item 8.3, Protected Disclosure Act 2022, impacts of legislation change, and I invite Catherine Shaki to the table.
Kia ora koutou. This paper, as you'll see, is reporting to you on steps that we've taken following the coming into effect of the new Protected Disclosures Act on the 1st of July of this year. What we've summarised in the paper is the key changes to the Act, and then attached for you what is an incredibly helpful summary from the Public Service Commission and a copy of our proposed, in fact, our new policy. And I'm really otherwise here for any questions or comments you might have.
Do we have any questions? Graham McGlynn.
It notes on page 26 at 12 that you're actively recruiting new employees into the role. Has there been any progress on that, and when are we likely to see the appointments being made?
This is work that the People and Capability team are undertaking. I confess I am the last remaining of the 3 protected disclosures officers in the organisation at the moment, and of course will only be here for 2 weeks longer. So they're undertaking that work as a matter of urgency, and I had conversations with them earlier this week. They're aware of the deadline looming.
Any further questions? Graham Naylor.
Thank you, Chair. Can I ask that we, I think it's commendable what we've done and make the changes to now be compliant with the new Act, but we need to test the protected disclosure process to make sure it actually works. So can I suggest we put down in the internal audit plan to consider some form of testing to make sure, because we need as a committee to make sure that works and complete the loop in terms of that things are being raised appropriately.
So we will add it to the rolling internal audit programme so there is visibility to this committee and schedule it at an appropriate time. And John, I can see at the back, is scribbling that down. So we will make sure that happens.
Thank you.
Well, I think I understand where you're coming from. Could you just widen a little bit of your thoughts as to what that testing might look like in your mind, what we are achieving?
Sorry, Chair. It's just we can have a policy, but if unless we know that it works, it doesn't achieve anything. I thought another option might be to monitor the number of disclosures made, but that may not be helpful. And so I think the only option for us is to do some testing to make sure that the processes work and are applied in accordance with the Act.
So I think in light, we had a review of our policy framework reported to this committee. There is a policy life cycle in terms of ensuring that we review the policy, that we communicate it and train, that we monitor compliance with the policy. And I think that it's following those steps as part of an internal audit. So one of the key things I'd be interested in is how have we communicated and made staff aware that this policy exists and how they can communicate or raise protected disclosures should they need to, and we can certainly do some work around that. I would agree with Graham that the numbers of protected disclosures may or may not be a useful indication of whether the policy has been successfully implemented and communicated.
Yeah.
Thank you, Giles. I think that was where I was trying to get to, that we have a system, the staff understand the system, and if we test it, we get that feedback as to their knowledge and ability to work. So I have Councillor Southworth followed by Councillor McGlynn.
Yeah, just interested in the got to work 20 working days from receiving the protected disclosure to then go through process. If we've got a disclosure officer, presumably there would be a requirement for that to be passed through because the 20 days refers to the organisation, but the disclosure the individual that's there who can receive that in the first instance then has to go through some process. So does the 20 days only start from when it's actually put into the organisation, or does the individual who's the disclosure, the recipient of that piece of disclosure? So I'm getting my terminology all wrong here, but you're setting up a person to receive concern. Does that person count as the organisation? Does that count? That's your 20 days.
Absolutely. So, and I haven't had any in the 6.5 years I've been in the role, which perhaps goes to Graham Naylor's question about numbers. But yes, the minute it was received by the officer, that counts as the organisation receiving it, and that starts the clock ticking.
Thank you. Independent member, McGlynn.
Thanks. I thought I'd had a promotion there, Mr. Chair, through you. Could I suggest maybe a way of understanding whether we have had an effective implementation would be a next year's staff survey to ask 2 or 3 questions such as, are you aware of the protected disclosure? Do you know who the disclosure officers are? And probably more critically, would you feel comfortable should a matter arise in raising it through this mechanism?
I think we can consider that. I'd also like to just stand back and go, which, if any, of our policies would we want to include in the staff survey, given that we have a multitude of staff of policies that it would be appropriate for us to understand whether staff understand them and whether we would select protected disclosures or whistleblowing as the one that we wanted to include in the staff survey. But I think there are various ways that we can make sure that people have been communicated with. As I said earlier, the general policy life cycle with all of our policies, is yes, do we have a policy? Is it up to date? And is it appropriate? But equally importantly, have we trained, educated and communicated to staff that it exists? Do they understand it? Are we monitoring compliance with it? And are we reporting that? And that applies to all of our policies, not just to our protected disclosures. But we are cognizant of that in terms of our whole policy framework, not just in relation to protected disclosures.
Thank you, Giles. Are there any further questions? If not, thank you, Catherine. We have on the screen the recommendation that we receive and note items 1, 2 and 3. Could I have a mover and seconder for those, please? Councillor Edge, Councillor Southworth. Are there any further conversations? Councillor Edge.
I just, on page 31, just wanted to note who this policy applies to, and it refers to all former and current employees, including members of ECan's governing body. So it's really, at some stage, being able to convey that to all councillors in terms of the policy and how it affects them.
Thank you, Councillor Edge. Any further comments, discussion? If not, all those in favour of the motions in front of us, please say aye.
Aye.
Against? Carried. We move now to item 8.4. He is rapidly thumbing through his agenda. Bancorp Treasury reports, quarter ending 30 June. Brian to introduce.
Thank you, Chair. In terms of the quarterly Treasury monitoring report, Bancorp is here to present their findings in their report and discuss the economic context that we are currently facing at the present time. I'll hand over to Miles O'Connor.
Oh, sorry, I think we pressed that. Thank you for the opportunity of presenting. So I'm Miles O'Connor. I work in the Christchurch office of Bancorp, as does David Walker here, my colleague. We've been advising Environment Canterbury for probably, I'd say, 7 or 8 years now on Treasury risk management. Principally, it's advising on the borrowing, although we also do advise on short-term investment, investing in the term deposit market as well. Would you like me to explain, for anyone who's not familiar, would you like me to briefly explain what Bancorp is and where we come from? Yes, please. So Bancorp is a merchant bank who are based in Auckland. The head office is in Auckland. We obviously, the two here based in Christchurch. The firm's been established since 1987. And on our side, there are a number of divisions to it. Our side is Bancorp Treasury. So we advise corporate and institutional clients on managing treasury risks. Now, that normally takes the form of advising on borrowing, but we also do have some investing clients as well. As far as the local government sector goes, it's our biggest sector. With our client base, we have about 200 or over 200 now ongoing clients. And local authorities, I think the latest number is about 35 or 36, 37 local authorities out of the 78 or so in New Zealand. The northernmost one is Far North District Council. The southernmost one is Invercargill City Council. So we're particularly strong in the South Island. I think we probably have more than 3/4 of the councils in the South Island as clients. And we are the largest treasury advisor, I think, in Australasia. That'd be true, wouldn't it? Say that. We have one main opposition. We sort of fight it out with them in the treasury advisory space. For Environment Canterbury, as I say, we advise on managing the debt. Principally, it's local government funding agency debt. Well, all of it is local government funding agency debt. ECan has been a member of has had access to the LGFA for, I think, probably 5 or 6 years now, and it has significantly lowered their borrowing costs. So that's the quick rundown on what Bancorp does. Would you like me to go through the presentation? Yes. Now, there is one change to the version that you would have got. The correct version is on the screen. Was a wee bit of a technical malfunction, and I just found it out about 9:25 this morning. But it has been updated. So is it just that one, Brian? So I'll probably spend 10, maybe 15 minutes at the most just going through the economic update. It is quite important at the moment what's happening because we are in pretty uncertain times. And this is a chart of the US and 10-year US and New Zealand 10-year government bond yields going back 2 years. Now you can see that back nearly at the start of the 2-year period, the two rates were pretty similar. New Zealand's in the black, sorry, and the US is in the red. The two rates were pretty similar, and then there was a bit of a dislocation between the two, and that was probably 18 months ago when New Zealand appeared to be the first country in the world. The central bank was giving indications that it would be the first central bank in the world to increase interest rates. So as a result of that, and that was a result of the inflation expectations that were coming through, the rates moved up quite sharply. I've used the 10-year yield here because that's the benchmark for global long-term rates. And they did move up until, now you can see that peak. Now that peak on the right-hand side there is June, 15th of June. So that was when interest rates peaked. And the reason for the very sharp rise up, say this year, is markets were focusing on the inflation trade. So they were looking at the prospects for higher inflation in the US. Well, it did get to 9.1%. It's 8.5% now. It's just come down a bit. New Zealand is 7.3%. New Zealand is a 30-year high with inflation. The US is a 40-year high. So the markets were focusing on the need for central banks to raise interest rates aggressively to control this inflation. Then on the 15th, I mean, they virtually turned on a dime.
And they then started focusing on the recession trade. And that was a result of it sounds a wee bit ironical, but it was as a result of pushing rates up with the inflation trade, because then they realized that, well, actually, the result of these increasing interest rates, these sharp increases in interest rates, well, actually could well be a recession. And then they started pushing expectations for future Reserve Bank policy and US Federal Reserve policy down. And that's why we've had the fall. And then just in the last 2 weeks, we've had a bit of a move up again. And that's probably because they've started gone back to a little bit of focusing on the inflation trade, the secondary results of inflation, while oil prices have come down. The wage pressures that are coming through as a result of some of the inflationary pressures that we're seeing. So it's left back there, isn't it? Is it? Yeah. There. But I just thought I'd put this chart in because this is a chart of various commodities. We've got oil, we've got wheat, aluminium. It's also got, well, the S&P iron ore in there, but it's also got the S&P 500. The top two ones, the red one is the oil price, and the next one down is the wheat price. Now, it's not the rates that's on the right-hand side that they're trading at, it's the change from, it's a common base of 100 on the left, isn't it? Yeah. So, because you can't put them all on the y-axis, the actual different rates. So it just shows that, particularly the increases in the oil price we saw with the invasion of Ukraine and the wheat price. But there are some signs now that commodity prices are coming off. This chart is a fairly good indication of them. And that is a bit of an early warning sign that perhaps inflation has peaked. So it may be that 9.1% that we did see in the US and the 7.3 that we've got now in New Zealand, that may represent the peak in inflation. And if that's the case, then we may have seen the peak in medium and long-term interest rates. And this is just it's a very specific chart. It's petrol prices, 91 octane at a Wellington service station. So that does show, the decline that we have had in oil prices. It's all very well to see the oil price chart for barrels, but this is actually the 91 octane price. So I thought, that was just a good indication of how much petrol prices have actually fallen over the last, what would it be, 6 weeks or so? I think probably everyone knows, filling up the car, it's slightly more palatable. Now, this is a horrible graph. There's probably no other way to describe it. So it's consumer confidence. And this is the Westpac McDermott Miller Confidence Survey. The question that they ask is this a good time or a bad time to buy a major household item? Now, you could probably interpret that two ways. Is it a good or a bad time to buy a major household item because you think the prices, say it's not a good time because you think prices are going to go down, or you need to buy it because prices are going up? Or, and I think this is the more likely explanation, is this a good time or a bad time to buy a major household item because you can afford it or you can't? I think that's probably that's the way that the question is framed. And what we've got at the moment is the worst reading ever since the series came in the late 80s. So it even transcends the beginning of COVID, the 2008 global financial crisis, tech wreck of the early 2000s, and the aftermath of the 87 share market crash. And I think the reason for it is just the cost of living increases, and particularly mortgage rates. Now, mortgage rates have doubled in a lot of cases. People were paying 2.5%, they've gone to 5%, some have even gone to 6%. The average first home buyer in New Zealand has a mortgage of $550,000. If it's, the increase in the price in the cost of the mortgage 2 or 3% could be between $10,000 and $15,000 after tax. I was just talking to one of the guys in our Auckland office, one of the young guys, he's got a modest house in Sandringham. He has a $1.1 million mortgage. He said it's going to cost him about $28,000 more. That's after tax. You factor in the cost of fuel, the increased cost of fuel, the increased cost of food, dare I say it, the increased cost of local body rates, insurance, and you can see that, there's going to be a lot less disposable income in the hands of in the hands of the consumers. And I was reading the other day, or about 6 weeks ago, that it's from the head of St Vincent de Paul in Hamilton, and he was saying that they are seeing an increasing number of people or families who have to decide who doesn't eat dinner tonight. So it's like they have a roster. If someone doesn't eat, you know, this is New Zealand, so this just shows the extent of the, the increase in inflation and how it's just absolutely eroded people's spending. And just to continue on being gloomy, New Zealand, the little New Zealand on the right is how how economic activity was in 2021. You could see it was going very well, and it's red and orange. But then we moved through to 2022, and those colours have changed. So the colours are tabled on the table on the left hand side of the west coast there. Probably the only good thing about this is that we're talking here because Canterbury seems to be the one area that has not been as badly affected as the rest of the country. I'm not sure what that little blob just northwest of Christchurch is. Yeah, I was wondering about that. If it could be that, I don't know if they're seeing less people in the hot pools, or hasn't been as good a ski season, or Methven's a bit further south, I think. Oh, it's the number. Yeah. Oh, sorry. Yeah. Now, this is the Reserve Bank of New Zealand, the OCR cycles. So OCR, the official cash rate. Now it isn't where the actual OCR is. It's the change from the change in the hiking or the easing cycles. So above the line is the hiking cycles, and below the line are the easing cycles. So you can see that we had a reasonable sort of tightening cycle prior to the global financial crisis. Then we had a very sharp fall in the cash rate as a result of the GFC. We then had further easings prior to COVID and the years before that. And now you can see on the very right hand side, that shows an increase of 2.75%. The OCR is at 3%, but it actually represents an increase of 2.75 because it started at 0.25%. The Reserve Bank are projecting the OCR to go to 4.1%. We had the monetary policy statement, yes, it was last week, where they actually increased the projected track of the OCR from a high of 3.9 up to this 4.1%. And then I think they're actually factoring in some slight easings in the cash rate. So this is quite an interesting graph. I know it's just numbers, but sorry, tables. Just to explain it, in both of the quadrants, the dates represent a monetary policy review date. So when a cash rate review date, an OCR review date. So when the Reserve Bank meets to look at the cash rate and either keep it the same, hike it, or ease it. The column under rate is where they believe the current one is 3% on the bottom one, but under the rate column is where they expect the OCR to be on those dates. Don't worry about the change from the current, but I think those are the two important ones now. In the top one, that was 15th of June, and that was when I said that that was when interest rates peaked, medium and long-term interest rates peaked. If you go down to the bottom there, so Wednesday, the 4th of August 23, at the bottom of the top quadrant, they were projecting the OCR to get to 4.74% then by October. Now, if we go down to the one for the 23rd of August, and this is the chart. So this is the page where there's just been a slight change to your one, but the one on the screen is the correct one. Then that's 4.09%. So they've bought it. So they've dropped it from 4.74 down to 4.09%. Actually, if I went back 2 weeks or 2.5 weeks, that 4.06 low was actually 3.65%. But as I said, they have just started to slightly refocus on the secondary effects of inflation. So they don't think that the previous decline isn't quite as significant as what they thought. But they still are projecting the OCR to peak in about the middle of next year. This is the markets compared to the OCR, 4.17% on 23rd of May, now 4.04%. Our view really is that the OCR will go up next month, is the next one. In October, that's early October, that's the next review date. It will go up and it'll go up by 50 basis points. I think then it starts to get a wee bit interesting. Will the Reserve Bank continue on this pretty hawkish stance and project further increases in inflation and therefore the need for further significant increases in the OCR? Or will they start to see the economic effects of the tightenings and the slowdown in economic activity, which we saw from that graph of New Zealand, how the economy is cooling? I'd struggle to see it above 4% at the most. I mean, I just think there'll be too much damage to the economy. It'll introduce too much hardship. We will go into it. We might even be in recession now. We won't know until the end of September, because we've already had a negative GDP print for the March quarter. So the technical definition of a recession is 2 consecutive quarters of negative GDP growth. And New Zealand's actually one of the last countries in the world to get the GDP number out. Why that is, I don't know. So we don't get it till the 3rd week in September. If that's a negative, then we're in a recession. If not, it may come later.
So just a question and a yes, no answer. So the hawkish stance plus probably 50 basis point rise may be enough to constrain the economy. Is that the view that's kind of starting to be thought about, as opposed to 50 plus 25 plus 50 or something of those lines? Is that the sentiment is changing? Is that enough to constrain it and pull back?
I think that the expectation is, and this is what's happened since the 15th of June, is that the tightenings that were factored into market pricing were actually too aggressive, and that they would actually lead to a recession. And therefore, I think there's a feeling developing, as you say, Mr. Chair, that maybe we don't have to go to that 4.5% in the OCR or that 4.75%, that somewhere between, we sort of feel between 3.5 and 4. My view is that they'll do 50 points in early October. Maybe they might start slowing down, and they could do a couple of 25s or 125, but we're struggling to see it above 4%.
Sorry, a follow-up question to that. Is the Reserve Bank responsible to avoid New Zealand going into recession? I took it from the Governor's last comments that he was less concerned about recession and more concerned about inflation. And you've said that.
The Reserve Bank has a dual mandate. It's a contract between the Reserve Bank Governor and the Minister of Finance, and that's to keep inflation between 1% and 3%, and also to maintain full employment. Full employment it's not actually specifically defined, but I mean, what are we at the moment? An unemployment rate of 3.2%. So I mean, we can take it that is full employment. There is no specific reference to they have to avoid a recession. It's controlling that inflation rate. Now, Orr is, Governor Orr is, he seems to be more focused on inflation at the risk of putting the country into recession. But I just sort of wonder, if we say we do get a negative print for the June quarter, it's going to make it pretty hard for him to keep hiking interest rates aggressively when the country's in recession. So I think, maybe that if that is official, then it may act as a bit of a break, but it will also show that economic activity is cooling. And as we saw from those inflation charts, the commodity prices, that maybe, we have seen the peak in inflation and it is starting to come down anyway.
Some very interesting items that you have raised, and I go back to the slide of good or bad time by a major household item, and just my observations out there is that businesses have quite long lead times to getting stock into their premises. At the moment, one business I was with is 18 to 24 months lead time. We had very good times looking at your 2 New Zealand maps 12 months ago, and everyone was quite bullish. Now we've got the interest rates rising, but we've got another factor that we have $10 billion a year. People weren't spending it overseas, and we've opened our borders. So people are suddenly saying it's time to get way the heck out of here and have a trip. So there's spending there. And I've got personally real concerns that retailers and wholesalers are going to have significant headwinds in the next 18 months because of excess stock that they're committed to from what they thought the spending patterns were back 12 months ago or even 6 months ago, before the borders opened and the bite of the increase in interest rates hits, and we could have some reasonably significant business failures happening over the next 12 to 24 months. Now, personally, I don't see that as a bad thing, because they're probably inefficient businesses and maybe those resources can be redirected somewhere else more efficiently. But we need to be pretty aware of that within our own forecasts and as a council and the LTP, the impacts on people, wage pressures that are there, and especially with the differences that we have often within private sector and public sector salary levels and expectations out there. There's a lot to be thinking about.
Thank you. Councillor Mackay, you had a quick question before we roll through.
Yeah, it was, and it goes back to the previous conversation of yourself and Councillor McKenzie around, do you see any signals of the recent change of opening the immigration borders? Because it's almost opposite to what the Labor government had taken the stance of a couple of years ago. And now they've sort of opened the borders a little bit. Is that a signal that perhaps the economy's not going as well, or there's something going on, as you've sort of alluded to? What might June figures look like?
David can answer that one.
Yeah, look, you raise a really good point, and it's something that we talk about constantly. But I think perhaps one of the unintended consequences of opening the borders is that it's in a lot of Kiwis' DNA that they want to travel. And there's sort of been this sort of pent-up demand to go overseas. And what we're finding now is really significant, particularly in professional services firms, about the number of staff that are leaving the country. And that has implications, in terms of the existing sort of resource scarcity. And obviously it means that people can negotiate significant raises for, salary increases. Interestingly, we saw a piece of research from BNZ, and they looked at what age groups were going overseas, and the one that stood out was the 25 to 29 year age group, and that's very significant because that's the younger people that have got the skills that we're kind of hoping that will be the management and the leaders of the future that are going overseas. And it's a tough call to know that when they'll come back, and that feeds back to perhaps Miles's point as well in terms of the change in focus. Like the leading indicators that we're seeing around inflation look quite encouraging. The one that we're really worried is about in terms of labour scarcity and labour costs, which is really hard to kind of forecast. But in terms of the moment, in terms of the opening of the borders, and in terms of the tourism thing, that's another good point as well. Arguably, that could be net negatives for New Zealand rather than positives.
Miles, yes, if we could roll through. Cheers.
Yeah, I'll just quickly go into this just to show the slide. So this is a slightly unusual slide, so just to explain it. The straight dark line is the OCR, and you can see it increasing. The not quite so straight dark line is the 90-day bank bill rate, and then the lighter blue line is the 5-year swap rate. So we often get asked, what are interest rates doing? And normally the question is, well, they're going up or they're going down. This at the moment, apart from the last 2 weeks, you can actually see there's a slightly unusual situation. From that 15th of June period up until, say, 2 weeks ago, medium and long-term rates were falling, and I showed in that first slide, and the 5-year swap is still quite a bit lower. It was actually 1% lower at one stage about 2 weeks ago than its peak on 15th of June. But that's while the OCR and the 90-day bank bill rate is increasing. So you can actually have one set of interest rates rising and one set of interest rates falling, so the medium and long-term rates. the reason for this is that markets are actually forward thinking and they are looking ahead. They've already factored into that high rate that we had on the 15th of June, all the increases that we've had. Now they're looking ahead to the easing cycle. And the fact that the Reserve Bank, it's a wee bit paradoxical, and while the OCR is going to be going up and the 90-day rate will go up further, markets are thinking ahead and saying, well, actually, we're going to have easings, and they're factoring that into the long-term rate. So it's a wee bit of an unusual situation that we've got at the moment. And just going forward, so just sort of tying it up with how this relates to Environment Canterbury. So this is your debt. This is what we call the debt and cover graph. The current debt level represented by the grey line is 79 million. The green line is the amount of fixed rate cover that you have, and the red lines are the policy bands. And the policy bands that's in the quarterly report that we have, you operate within 3 bands: 0 to 2 years, 2 to 4 years, and 4 to 8 years, with minimum and maximum hedging percentages. So I think, Environment Canterbury is in a pretty good position. Ideally, we would want to have more fixed rate cover than what we've got. But look, with the benefit of hindsight, I mean, not even the 800 PhD qualified economists at the Federal Reserve predicted that interest rates would rise to this extent. When rates were low, central banks were saying that they're going to go negative. New Zealand was one of them. Banks were telling clients not, and in some cases weren't even allowing them to take fixed rate cover. So Environment Canterbury, because of the amount of fixed rate cover you've got, you have a reasonable buffer against rising rates, but the cost of funds has gone up. But I think I haven't done it for the June quarter yet, but in the March quarter, you had the 7th lowest cost of funds of any of our local authority clients, and I'm pretty sure that, knowing what some of the other cost of funds were of our non-clients, that you probably would be at least in the bottom 10, as far as the lowest interest rates go. So. Compared to, certainly in the bottom quartile still now, so you are in a fairly good position, well, a very good position as far as your cost of funds goes. And then the last chart is the maturity profile. So that just shows when your debt, the underlying debt. So the previous slide was your fixed to floating percentages. This is the debt maturity profile, and shows that you've got a good spread of debt maturities out to 8 years. So that also offers some comfort as well, in that we have a good even spread of maturities, and you don't have it's not overly concentrated. So that's the presentation.
Thank you, Miles. Really appreciated that from my perspective, and I feel better about having all my business stuff on a floating rate. Not that I can afford to pay my interest bill, but I can marginally. I feel somewhat better. Questions?
Yeah, thanks, John. Just as a invitee, I guess, into this meeting, but thanks for that. It's really quite illuminating. Not a heap of questions, but I guess my main question of you is, given that preview of the financial state going out, so let's say the next triennium for this council. We were quite expansive when we came in pre-COVID in 2019 in terms of things we were doing, and we know now that just some of the infrastructure costs that ratepayers and taxpayers are wanting to pay for. You can see the stadium, it's a classic example. Mia Brown in Ashburton tells me that the bridge that we costed at 40 million is now $110 million. So the Crown are going to be able to do less with with more. They're going to be able to do less projects. So what would your advice be for the next triennium for this council? Would it be a conservative approach to how we're doing it? Because we have to go out to the ratepayers and get their money. And if those pressures that you're saying are on them, or on the taxpayers and ratepayers, where do you see that at? The ability of the public to pay for services, I guess. You might not want to answer that.
Yeah, okay. We're not actually paid that much to answer that question. We acknowledge that there are going to be, significant headwinds, especially for the next 12 months or so, and we may well go into recession. And that consumer confidence graph, is probably the very illuminating one. And certainly, there are those pressures on households which are going to constrain what they can spend money on. So, and the other point you raised, it's one David always brings up, is the increased cost of infrastructure as well.
Yeah, we've kind of heard stories of infrastructure inflation running around about 20%, but those numbers sort of pale into significance in terms of the numbers you've outlined. I think one of the interesting things, though, is that when you're committing to, spend or infrastructure spend, you're probably talking about a 3-year lead anyway before you can actually shovels hit the ground, that type of thing anyway. And hopefully by that sort of situation, if you look at most of the economists and the forecast, the trouble we're going to have in the economy is probably going to be in the next year, maybe 18 months. So hopefully by the time that, you would actually have to start to write the checks for the projects, that most would be in a better economic situation.
I guess my point that I'm trying to make is that we don't deal with disposable income. It's like base income for us, because the services that we do provide and the city do provide. So it's just one of those things that goes in the jam jar every week. It has to be there for us to do what we want to do. But I think that I think that pointing to that graph is a pretty good indicator for us that things are tight.
Look, I mean, I've been probably fairly negative and pessimistic here, but unfortunately, it's what we're seeing at the moment. But look, one of the good things is, with the borders opening up in tourism, David gets sick, but I'm an aviation nerd, so I always follow flying. But I mean, from what I hear from friends who are pilots and that, and working for Air New Zealand, the forward bookings are incredibly strong. And one of the people who works in our group of officers is one of the biggest inbound tour operators, and he said that their forward bookings are some of the strongest they've seen. Now, okay, some of that is family and friends coming to visit, but certainly the opening up of the borders, it looks very encouraging for tourism, and you've also got the foreign students as well. So maybe those are two bright lights on the horizon, to counter some of the negative effects. But yes, I know your point is that what you are doing is essential. It's not going to the pub and it's not going out to a restaurant or anything. This is the fact of getting up in the morning and having to survive, basically, and that's what you're, I think, coming from.
And maybe a glass half full comment. I think, like all things in life, you've got to believe in the long game. So I think New Zealand will have some, short-term issues, as we've just sort of outlined. But I was talking about the longer-term outlook for New Zealand. Looks very good.
Thank you, Graham Naylor, followed by Councillor Edge, and then we might move on.
Thank you, Chair. An excellent presentation from Bancorp. Thank you. Can I ask management, is ECan fully compliant with all debt covenants at the present time? And can I also ask that be included in future quarterly reports, please?
Yes, I can confirm we're compliant with all our covenants at this point. It's something we review annually as to that compliance, but yes, we have recently done that.
Just one thing I could add, there are 3 covenants that the LGFA require you to comply with. Well, 4 really. It's debt as a percentage of revenue, its interest as a percentage of rates, and its interest as a percentage of total revenue plus. So there are metrics around that. You're compliant with all of them. We can put those in the report. Also liquidity, and you have to maintain 110% liquidity, which you do. While you don't have a bank facility, your holdings of bonds, term deposits, actually counts as liquidity. So those 4 parameters that we see, yes, you are compliant. We can put those in the report if you like.
Thank you.
Thank you. Councillor Edge, then Councillor Southworth, and then move on.
Just quickly, thank you very much for that. I mean, you do paint there is a bit of an issue going forward, but we're in the business of looking forward, intergenerational things that we've got to consider. In terms of light at the end of the tunnel, there's a few things that are happening to our economy. We have tourism, and people are on TV this morning talking about the boom down south. So that is encouraging, if you suggest. And also recently free trade agreements with the UK, which are projected to earn us billions of dollars an additional income. So that's potentially another picture. Climate change is a big issue for the nation and for Canterbury. In terms of expenditure on infrastructure and dealing with climate change issues, big money might have to be spent on that. The other way of doing that is being more clever about how we deal with adaptation. Do you think that there are things that need to be brought into play in terms of thinking about where the Treasury might land? And I say that because we did have an economist talking to us not so long ago, suggesting that the Treasury's never been right in their predictions. So I wonder if you could comment on that.
I have actually got a graph at work which plots the, it's a firm called Consensus Forecaster based in London, and they poll about 100 different economies, forecasters and financial market participants like ourselves. We're not really economists, economists and market participants, and it's where they see interest rates of currencies in 100 different economies, and one of them is New Zealand. We've got a chart of the 90-day bank bill rate and also the currency, but the 90-day bank bill rate, it's where their projections were, and then it overlays, where it actually went. And the only thing that's consistent is that they're almost wrong all the time. They're right about 10% of the time. Sometimes they get the direction right, but not the extent of the move. As to David, you're probably better on the climate change one than I am.
Oh, look, it's a huge issue. Is there a bigger issue? Hard to say. Well, hard to think about anything else. But yes, understand that there may have to be big checks. Something that we have been talking about is that, and we encourage more dialogue in terms of this, is the LGFA offers green or GSS funding, which allows a small discount to your funding costs if you meet certain criteria in terms of funding associated with infrastructure type assets. So that would be something that A, has a financial benefit, and I think B, has really great optics for the broader community as well. So that's something that I encourage council to have a look at.
Yeah, I did a comment on the climate change. I was going to make a comment that so far I don't think any economy has switched off its consumer spending from carbon increase. And we've seen with Nelson just how huge the cost can be with what's coming with climate change. So I think for us to have a very short-term year, 2-year focus, acknowledging, of course, we need to really be paying great attention to people who are struggling to put food on the table. I mean, thank you for raising that and being connected to people who can tell you those stories, because we really, really need to remember that. But in terms of getting to your report and the question, we've got 2-term deposits that we've just we fixed in this report, so 12-month and a 24-month. And it seems from what I'm in the right report, aren't I? Yeah. On point 9, got 2-term deposits reinvested, 1 for 12 months, 1 for 24 months. Now, from what I've just heard in the your reporting, there's an expectation we're going to have some rises, some falls, but there's uncertainty in that. And I just said there's a real lot of uncertainty in that. So what's the logic of going for what seem like relatively short-term fixes rather than for a longer period where we know if it's going up and down a bit? Currently, we're probably reasonably, is there some sense in actually locking in fixed term for longer? Have I jumped to the wrong report? So I'm looking, the 8.4. Sorry, God, like you, like uncertain face.
Sorry, this is the financial market investment portfolio. So we normally just we've been going out a year just because it's a balance between yield and term. But for the first time, actually, we went out for 2 years back in when we did the 1.6 million. We got 5.03% because that sort of corresponded to that roughly that peak in June. So we just saw that rate as being above 5%, and I thought it justified going out 2 years rather than just sticking to the 1 year. What we are starting to look at, and which I need to bring up with Brian and Giles, is the possibility of investing in the bond market. Environment Canterbury did have some investments in bonds. Luckily, you haven't, because over the last, if you've invested in bonds, then there's been a negative return for the last 3 years, I think. Whereas term deposits, you haven't had that. But just if we have seen that peak in interest rates, then A, it was worthwhile doing that 2-year one. But secondly, I think we could even look further, which you're allowed to under your Treasury policy invest in corporate bonds which have a specific credit rating or a minimum credit rating.
I'm just going back to Miles' point that the field we're involved in is art as much as it is a science. And what we constantly have to look at is what is priced in. And at that point in time, when we looked at, how much expectations of future interest rates were already priced into the term deposit market, and in terms of the bank's demand for funds and what they're prepared to pay for money at that point, it seemed to make a lot of sense. So, because I think in the graph that we've shown, those expectations around what's going to happen in the future, they change quite significantly. So
really, it's things are fluctuating so rapidly that the decision you made 2 months ago may not actually be the same as what you'd make if you were making it today. It's that volatile.
That's correct. Yes. Yeah.
What we've seen in the last month, 6 weeks, is some of the volatility we've seen is unprecedented over the last 10, 12 years. It's phenomenal. I mean, to see long-term interest rates come down 1% in the course of a month is a very significant move.
Thank you very much. Did you have a question, Megan, or were we going to move on?
Probably. I hope it should be a fastish answer. It sort of relates to what you've said around the bond markets, but I guess looking at our debt and our low cost of funds that you've referred to, and we've often talked about how this council has limited other asset in terms of income generating asset. Given the climate, if we're looking at recession, do you see that there could be potential investment opportunities for those with low cost of funds or significant headroom? Is that something that's, in terms of for investors or for organisations like ourselves who, if we wanted to go into an investment mode, is there an opportunity given the market is declining?
Sorry, did you hear that?
Yes.
Yeah. So does that give you the opportunity to borrow at reasonably low rates, therefore to make an investment? Well, we can answer the first question. I mean, yes, these, I don't know if interest rates will go up too much because further, so I don't think your cost of funds will go up. We're not really involved in the investment side of it. We come from a position of once you've got the debt, it's not for us to say, this is what you should have debt for. This is what you should be investing in. It's Brian and Giles come to us once they have decided that you need the money, and then our job is how you fund it. So I'm probably not quite qualified to.
I just want to give it the wider economic context that you've outlined.
I mean, yes, there could be asset, there could be fire sale assets coming up. Graham, you might know a bit more about that, possibly.
I think we'll move on. I think it's not really a question for Miles and Co. Do we have any further questions? Any further comments from you, Miles? If not, then I thank you very much for this report and the conversation that we've had. I think it ties a lot of things together and provides us with some great information and the confidence of where we're sitting with our debt, maturities, and that we are within our covenants. So thank you very much for your time. Can I have someone then please move and second that we receive this report? Ian McKenzie moved, seconded by Councillor Megan Hands. All those in favour, please say aye. Against? Carried. Thank you, team. Great. We move now to item 8.5, Portfolio Health and Financial, July 2022.
Yes, we're really pleased to actually produce the first July month reports for financials. We're quite surprised to find that we're doing that, but we certainly aim to report all 12 months of the year as we go. Fundamentally, the issue with July is, of course, that we've got very little track record for the year. So there are very few actual discernible trends that we can choose to comment as. So you'll notice that there is a general lack of verbal commentary attached to this report. However, at this point in the year, it is a positive story. We're underspending at this point in the game, and our cash remains strong at this point. So it's really an initial snapshot of progress in the year, but very, very, very early at this stage. So any questions?
Thank you, Brian. I think we might just take this report as read, given that it is a 1 month snapshot, and appreciate that you have been able to pull this together in the fact that you haven't, or we haven't in previous years been able to do so. Are there any questions? None. Thank you. Then can I ask that someone please move that we receive this report? Thank you, Councillor Marshall. Seconded, Graham McGlynn. All those in favour, please say aye. Against? Carried. We move then to item 8.6, draft year-end 2021-22 results.
Fundamentally, this is kind of old news at this point. I think probably the key point we want to draw out of this report is that where management promised the council to make $1 million operational saving for the 21-22 year, and in order to put those into reserves for the 22-23 annual plan, that has been achieved at this point. You'll notice that the report is what referred to as the draft. We are also undergoing substantial adjustments for property and other asset revaluations at this time. So the final annual report will look more than substantially different. Just as an indicator is that we're seeing our flood recovery assets being revalued upwards by about $170 million. So I would estimate we're probably going to have upward increases in our balance sheet assets of about $200 million for this year. So the annual report will look substantially different. But in terms of operational performance, we have achieved what our goals were at this time. And of course, the other good news is that Fitch have reconfirmed our credit rating at this point.
Thank you, Brian. And it is pleasing to have hit that target and goal of having a positive balance that can then be put towards reserves. In past years, we may have had it indicated to us that we were on track to do things and they haven't quite materialised. So that plus our credit rating intact is great news. Graham McGlynn, a question.
Just through you, Chair, the question I have is the usual one at this time from a bean counter, and that is the reserves and looking at the projects underway, whether we've been through and completely reviewed those, and that is, and all changes to reserves that are needed to reflect into period allocations, etc., have been done.
Yes, we've been in the process of doing a thorough reserves analysis, and we've actually just completed a project of actually setting them out and all the movements for the year, so that we'll be able to report in a more transparent way about those reserves in future. So a very timely question.
Thanks, John. Just your comments about the revaluation of the flood protection assets. Is that because of the money we've spent on fixing flood repair damage, or is that a revaluation? Oh, yeah. Can you just perhaps go into a bit more detail?
Sure. What we're seeing across the board is because of the inflationary effects and construction costs, basically. So we're seeing cost of transport, cost of inputs into the building, etc., have just increased massively, and so the average unit cost is going like that.
And so you've then applied that costing to existing infrastructure, or is this revaluation only applied to new stuff?
No, the revaluation is to everything, and it's actually done predominantly by external valuers who do a full reconciliation of pluses and minuses in terms of build and losses, etc., as well as revaluing the base, which is still there. So it's a complex piece of work, but Audit New Zealand check it pretty thoroughly. So we're fairly confident that the results, although very large numbers, are pretty accurate.
Thank you for letting me ask a question. So balance sheet implications more than anything, and increased depreciation cost.
Yeah, fundamentally, that's what's being affected is the balance sheet. The upside, I guess, is that the bigger our balance sheet grows, the more potential debt we may be able to carry in the future.
Very brief. At the moment, as I understand, the value of our flood protection assets are around 65 million. Do you have a figure as to what you think the new valuation is likely to be?
We actually have about 650 million in that space. And so if we add 170 million, it's going to be close around the $800 million mark.
Thank you, Brian. Any further questions, clarifications? If not, can I have someone then please move that we receive this financial health report for the year ending 30 June 2022. Councillor Hands, Councillor Edge, all those in favour, please say aye. Against? Carried. Thank you. We move then to item 8.7, Office of the Controller and Auditor-General Integrity Framework.
Giles.
Just very briefly, Chair, for the committee's information, the Auditor-General's published a report on putting integrity at the core of how public organisations operate. I felt it was important to draw this to the committee's attention. Obviously, we pride ourselves on the 5 values that we operate under, one of which is Panonga, which obviously is integrity. So we do not believe it will have a fundamental impact on what we need to do or how we operate, but it does reinforce the importance of integrity in everything that we do. I'm happy to answer any questions, but it's more for information, really.
Surveying the room, I see no hands. If there are none, could I have someone then please move that we receive the Integrity Framework document produced by the Office of the Controller and Auditor-General? Councillor Edge, Councillor Mackenzie. No further questions. All those in favour, please say aye. Against? Carried. We move then to 9, is it? Yep, that's fine. So we are just about to move to, when we get organised, resolution to go into public excluded. I just make you aware that at 12 we have the obligatory how many minute break? 10, and then at 12:30 we have luncheon. So I was thinking we'll be finished and done, but now we have these breaks and luncheon. So I'm hoping we'll be done. We could. I mean, we will take time to go through this report. I'm just running through my mind of where we will end up as, and hopefully not too close to 2 o'clock, bringing the breaks and the like. So just something to think about between now and 12 when we do have a break. We're back. Thank you, everyone. This has been a huge day, and we have got through a lot of work, and I think created a lot of, I guess, understanding of where we are positioned as a council and the works and actions that our senior leadership team are putting in place to take us to a better place, reduce some of the risk and anxiety that I think we all note when we have seen and read these reports. And I look forward to the day when we will have a meeting where we will have updates and reports on these matters, where we can be excited by the progress that we've made and not have to delve too far into the past or whatever, and be able to move on. So thank you for that. Our next meeting is September the 15th. And if I could ask Nicole to close, is it possible? Thank you.
Inahia ki te urutapu nui o tāne, kia wātia, kia māma, te nākau, te tinana, te wairua I te ara takata, koiara, irongo, whakairia, I think I messed it up, kia runga, kia tina, homie, hui, taiki.
Very good. Sure.